Let's record this bad boy. All right, we're live. What's up, guys? Hey, Facebook friends. I was talking with my buddy Kevin Bupp. I was actually on his podcast a week or two ago, and he's like an absolute ace, an absolute stud when it comes to mobile home park investing. And he's invested in a lot of different things. He's passively invested in some things, has owned hundreds of single family houses, had several hundred apartment doors, and really just focuses on mobile home parks right now, and is getting into some other stuff too that we'll dive into. So I had such a good conversation with him. He's a good friend of mine. We're in a couple of masterminds and stuff together that I wanted to have him on and just try to give you guys some insight on different types of asset classes. I know I'm a commercial real estate multifamily guy primarily, but I'm invested in vacation rentals. I'm invested in self-storage facilities. I'm looking at a whole bunch of mobile home parks. I haven't pulled the trigger on any yet, but we might be doing a deal together, Kevin, based on sending some text messages over the weekend.
Yeah.
And I'm looking at some other stuff down in South Carolina, and I own some retail, I own some office, I own a whole bunch of other different stuff. So there's benefits to every different asset class, and there's a million different ways to make millions and millions of dollars in real estate, including commercial real estate. So I figured that'd be some good banter to talk back and forth on. So Kevin, dude, appreciate you being here, man. Thanks for carving out some time.
Yeah, buddy. Thanks for having me, man. I'm looking forward to it.
Yeah. So we always have good conversations. So why don't you give everybody some background on how you got involved in real estate in the first place? And I know you went through that whole market cycle and the whole downturn back in 07, 08. And tell people about, your real estate career leading up to that, and then what you've been doing since.
Yeah. I'll try to give the condensed version. So I'm 41 now, and I've been a full-time investor since, I like to say, the age of 20. That's when I bought my very first property. But I got introduced to real estate at 19, and real estate kind of found me, Tim. It was kind of a cool thing because a lot of people go out searching for it because they've been kind of jaded by their career, the corporate world, what have you, or they're just looking for something bigger. And I wanted something bigger. I was at an age where I was a little confused. I was, going to community college, not knowing what I wanted to do with my life. And I just very grateful that it came and found me through the means of a guy by the name of David. David was dating my girlfriend's mother at the time. So kind of a strange story, but in a roundabout way, real estate found me. He was a local real estate investor up in Pennsylvania, a small town where I grew up, and lived a very different lifestyle than what I was used to growing up. I mean, I never went without. My parents gave us everything we ever needed, and it's all relative, right? Like, you only know what you know. And, we went in one family vacation a year. We always look forward to it. It was fun. And, always had stuff, and again, never went without food on the table or anything like that. So it's not a poor me story. But David lived a very different lifestyle. He was always around. Like during the day, I would take a break in between classes, go see my girlfriend, and he'd be by the house sometimes. I'm like, shouldn't he be at work? Right? That's what old people do. They should be at work during the day, 9 to 5, and drove really nice cars. Just again, very different lifestyle. And so I was just intrigued by what he did, but I didn't really understand it. And over a couple of months, Dave and I became close. I was over at their house. They'd have us over for dinner, things like that. And just got to know him. Again, not really understand his business all that well. It was just way over my head, I felt, at that point in my life. And but he ultimately must have seen something missing in me, or like a young kid searching for something, not knowing what he was searching for. So he invited me to a real estate boot camp down in Philadelphia. It's a 3-day. Ron LeGrand, the guy's still around. I don't know how old he must be in his 70s now. And it was a fix and flip 3-day, and David's partner couldn't go with him. And so he had already paid for the tickets. It was, a couple $1,000. And I was like, what the hell? I mean, what do I have to lose? Right. Let's go figure this thing out and see how to make some money. And I went and was overwhelmed, was excited, had all kinds of different emotions roll through my body. But the cool thing about it, Tim, was that during that period of time, I met a lot of people, during those 3 days that were doing, to me, what seemed to be just massive things, right? I mean, doing deals where they were making, on maybe a wholesale $5,000, $6,000, $7,000, which was like just unheard of at the age of 19, or doing flips and making $20,000, $30,000, $40,000, and they're doing multiple a year. And I didn't feel like they were any smarter than I. They knew more about real estate than I did, but I didn't feel like they were at a different IQ level than what I was. They just had been doing it a little longer. And so I left there just, excited and ready to roll. But again, kind of hit a roadblock saying, what the hell? Like, this is great and all, but like, I don't even know what the next steps are really. Like, the manual kind of taught you, like, go put some ads out, but we buy houses signs out, but I needed some more direction. And I essentially went to Dave and said, hey, how can I help you with your business, man? Like, I attend bar 3 nights a week. I go to school. I take 12 credits. And I got a good bit of extra time. Like, I'm around during the day. I'm around whenever, and I want to help you through business. Where do you need help? Right. So he was about 25 years older than I knew he had some challenges with technology and things like that. And so I just offered my assistance to him, services in any way possible, and he accepted. And so essentially what happened is I became his, I don't know, admin assistant, coffee fetcher, errand runner, whatever he needed me to be. I did that for about 14 months, and was just around him as much as possible to learn the ins and outs of his business. Listen to him
Did he have
talk.
A big business?
No, I mean, he owned, I think about 60 rental properties, between small multifamily stuff and single family houses. He owned a lot of stuff free and clear. He'd been doing it quite some time. Right. And so in the small town I grew up in, he was like a Trump, right? He was like a Donald Trump, you know what I mean? Like, and to me, it was big, way bigger than I had ever, wealthier than any person I'd ever met in my life. Anyway, in any event, I learned a lot from him, and ultimately introduced me to a lot of folks in the business. And I bought my first property about, shortly a year after being around him. And I was off and running. I mean, I didn't want to fix what wasn't broken. All I knew to do was to model what he had done, because it seemed to be successful for him in building a lifestyle. And I learned very quickly his model didn't necessarily work for me right away. And so he was all about buying and holding, right? Which I am today. However, that didn't work well when I didn't have a lot of capital. And so I used like the $7,000 I'd saved attending bar to buy that first property along with a private lender. And I intended to hold it. After a couple of months of holding it and having it as a rental, realized that $200 a month of cash flow is going to take a really long time to buy that next property. And so I had to modify the model a little bit. And so I would basically wholesale 2 or 3 properties and try to hold one, wholesale 2 or 3, try to hold one. It would vary over time, but that was my long-term objective, was to buy and hold rental real estate and create a passive income stream out of it. And so that was my foray into real estate. And I continued with that model and scaled it up, moved to Florida. About 2 years after.
Isn't it interesting how everybody gets into real estate because they want passive income and they want residual income? And then every single person I know gets stuck in this transactional rat race, right? On the hamster wheel of trading their time for money and wholesaling deals and flipping deals, because we all think that we need to stockpile our own cash in order to roll it into and buy these passive income producing assets. And knowing what you know now, like how much money do we actually put into our own deal? Like, there's so much money out there that people want to passively invest with us that you don't need your own money. You can go out and start doing
I agree.
And buying and holding passive deals right away.
Well, I think it's all about who you surround yourself with, right? Like at that point in time, I was only surrounding myself with David and like his immediate network, and his immediate network did exactly what he did, right? And I hadn't expanded my horizons enough yet. And where I grew up was a small town. Like I had to drive 2 hours to get to the local real estate meetup club. I mean, like there was nothing in my town. I had to go to Philadelphia, like a big city, to get to one. And so, I mean, it's all about expanding horizons. I mean, I know you teach a lot about that, like really just expanding your network and opening your eyes to the bigger picture. And so it took me, multiple years to do that. And I kind of learned through trial and error, just like a lot of us do in the beginning, and realized that there was a much bigger game to be played. But you're absolutely right. I mean, it's getting stuck in that transactional phase. I mean, it's a death wish, man. I mean, there's only so many hours of the day. I mean, there's only so much bandwidth that you have as an individual. And if you're seeking financial freedom, that is not the way to it at all, because all you're going to get stuck in is a, 60, 70, 80 hour job, really, more than anything else.
And it's one of those things where, you get into it, and then all of a sudden you learn about private money, and you learn about syndicating or raising money, and kind of just, creating partnerships and joint ventures and all sorts of different stuff. And it's okay to fall into the transactional rat race as long as you don't stay in it, right? Like I see people who just keep on staying in that, and they're doing the exact same thing, and they have the same problems when they've been in the business for 25 years as the problems that I had when I was 2 years in the business, right? Like, dude, you got to grow, right? And so, now that you're aware that you can go out and raise money and syndicate deals and joint venture on deals with passive lenders, it's a different animal. So, so you moved to Florida. Sorry about that.
Yeah, no. And I was going to, let me add another point there. I think it's important to master your craft. There's a lot of private money out there. There's a lot of capital, but like you got to understand what your model is, right? You got to be really good at it so that you can execute on that plan accordingly, especially if you're going to take capital from outside sources, capital that's not your own. And so I do think that there's a certain stage you have to go through of proving your concept. It doesn't have to be a long stage, right? Like, but I do think that you need to prove that concept before you go out there to the world and actually start, bringing in capital to, feed that machine that you're building. So that's my personal opinion.
At least shoot straight with them and say, hey, this is the first deal I've ever done.
Yeah.
Right? We're in
Fair
this
enough.
together,
Fair enough.
I'm going to give you 80% of the deal, and you know, it's a
Yep.
risk reward type thing. So,
Yep.
I did bring in some private money on my first buy and hold, which is, I don't know, the first couple of deals that I did. And, I paid this lady 11% for like 5 years. She made 11%
Yeah.
on her IRA for the next 5 years. And, she was willing to roll with me. Right. And so it was a good deal for her. Sweet deal. Got me into my first buy and hold, and really like, culminated. But I shot straight with her. I was like, listen, I flipped houses. I've done some other transactional stuff. It's my first buy and hold. And, she's like, yeah, no, that's good. You know, primary first in position. And she was 40 cents on the dollar, you know, so
well, that's it. So her risk point was really low. I mean, my first deal I had private money as well. So I think it's all about just honesty and transparency. You know, the whole, I get a little bit of the fake it till you make it, but I mean, at a certain point, it's like honesty and transparency wins the game, guys. It really does. I mean, so don't like be out there promoting yourself as something that you're not, because you're going to get exposed very quickly, especially like in the time we're at right now. Like those that have been, you know, flaunting themselves that ultimately aren't what they say they are. Well, you know, it's going to take some time here, but give it 12 or 18 months. There will be a lot of those folks exposed over this period of time.
Some of them have already been exposed and already wiped out of the business, man. It's crazy.
You think that quickly?
I've seen a couple. It's crazy.
That's surprising, because I don't think the last couple of months, buddy, are really the barometer of what's about to come. I mean, like we're still like in the first inning of the game. I mean, that's it. I mean, we haven't even moved on yet. The momentum really is just picking up as far as, you know, what these last couple of months of the economy being completely shut down is going to bring as far as pain. At least, again, I'm not an economist, but that's just how I feel. I think it's inevitable.
Well, I think it's definitely, it's hard to speculate on any direction, right? Like, who knows? Nobody's ever lived through any of this stuff before, but you know, I've said this before, but I think there's always going to be good deals. And I think as long as you always have good buying parameters, there were good deals and bad deals a year ago. There's going to be good deals and bad deals a year from now. There's good deals and bad deals today. So, you know, what kind of deals are you buying? Are you buying at a low enough basis? Are you creating a value add structure where you're creating appreciation instead of speculating and hoping on it? You know, are you buying for cash flow versus, you know, hopefully it goes up in value tomorrow and it's worth more tomorrow than it is today. Right. So, you know, doing those kinds of things. So tell me a little bit more about how you started growing your portfolio.
Yeah. And so I moved to Florida, which was like big city for me, right? Moving to Tampa back in like 2002 was from where I came from. And Tampa's not a huge city. I mean, it's a growing city, but it's by no means a large city. But to me, it was. And there was a lot of.
You're from Pennsylvania originally?
Yeah, from Harrisburg, Pennsylvania. I mean, it's a capital, but it's small. You know, I don't even know what the population, but it's a small area. And it's a very stagnant area. Like things just don't change there. I go back and I see buddies from high school that are literally doing the same things that they were doing 20 years ago. Right. So it's just a very stagnant area. In any event, I moved down here, and down here, it was a thriving. It's funny, if you go back and talk to people that were in real estate 20 years ago, they'll tell you that like the Tampa Bay area was like the mecca for like gurus. Like that's where like they all originated. That's like where all the roots were grown from. And like all the, you know, late night, study courses, what have you. Yeah. They're all like based out of the Tampa Bay area. So, I mean, there was like literally 3 real estate investment clubs, like all within a 15-mile radius of my house. And so like, I just got very ingrained in the local real estate groups, and just started buying, literally started what I was doing in Pennsylvania, just multiplied it by 10. I mean, just the opportunity was here. The resources was here. I mean, it just was like open playing field for me to build a large business. And that's what I did. I just got hooked up with the right folks, the right resources, right services, just build a business and started buying single family in a very big way. Again, that was all I really knew, Tim. I mean, I knew the single family model. I wasn't going to reinvent the wheel. We buy small multifamily stuff as well. But I learned very quickly, and actually I wouldn't say very quickly, because I ended up going through a crash and losing a lot of everything. But probably about in 2005, I realized how many inefficiencies there were in my business. And again, this is nothing against single family real estate. This is not saying one's better than the other, what have you, but we owned single family properties in many different counties, and just the inefficiencies that existed with the maintenance and the leasing and every other aspect of running the property, it was horrible. So even though we had a very low basis on all of our properties, so we were like really to the point on, buying things at 65%, on the dollar, after factoring all the repairs, maintenance, what have you. And so like really low basis on our properties. But even then, the inefficiencies that got thrown in with the management and the maintenance and the leasing and all that just threw it out the window, threw all the proceeds and the profits and potential cash flows out the window. And I mean, they did cash flow, but like that in an up market, just like we were just like in an up market, anything cash flows, right? Anyone looks like a genius in an up market. And so while we had a low basis and we looked great on paper, when 2008 came to call, very quickly we realized that, number one, Florida took a massive hit. It was one of the ground zeros, one of the many ground zeros that took a huge hit in 2008. And there was a lot of jobs that were based on construction, like lots of service-based jobs that ultimately went away for a period of time, and lots of property, lots of areas that were overbuilt. And so we became a competitive market of us betting against apartment complexes, spec builders that built things that were starting to rent them out, and basically trying, cutting our rates down. So our rents were going down. In addition to that, our inefficiencies were going up. And so it just became a very challenging time for us to run a portfolio that was already inefficient. In addition to that, we're going through this massive downturn. And so I look back at what I would have done differently. And I had mentioned to you before we jumped this call, I also own some multifamily property. I ended up acquiring about 500 doors, and these were all like 24, 48. I think our biggest one was like 72 units. So smaller multifamily properties. Most of them I was a GP in, but I was in a passive side of things. I wasn't overly involved. I just, put a lot of the money in, and I didn't run that side of our business, but those things just seemed to do well. I didn't really spend much time in it. They cash flowed, but the single family side of my business was a catastrophe all the time. It was just always like, just a complete mess. Always. And I was like, Jesus Christ, like I'm spending all this time and energy over here when I should have just been spending it over here the last couple of years. But you got that big machine. It's hard. It's like turning a cruise ship, right? It takes a lot of time and energy, and you get complacent and you get lazy. And I just want to keep doing what I'm doing and not shift it. And then 2008 happened, and everything came apart. The wheels came undone, and the bus came to a screeching halt. So
what happened? So I was in real estate,
right,
2005, but I didn't start investing until 2009, thankfully, right? I don't know if it was a timing thing, luck thing. But I was in real estate. I had construction business. I worked for a big home builder as an intern. I was a broker, all that kind of stuff. But I didn't really start investing until the bottom of the market. What was going on, and what did you see? I've studied a lot of it because I saw a lot of people that I was in business with who were worth this much and went to this much.
Yeah,
and I saw a lot of people who were worth this much and then went this way, right?
Mm-hmm.
What are some of the differentiating factors of the people who were able to make it through that or didn't make it through that, based on the people themselves or their business model or the types of assets they bought? Can you speak to that at all?
Yeah. No, I mean, if I want to be truthfully honest, brutally honest about our business model, that single family home side of our portfolio, when you really get down to the nitty gritty, it wasn't a real cash flow model. I mean, it's as simple as that. I mean, it looked phenomenal on paper, being that we had a substantial amount of equity. With that equity, that's just funny money, right? It's just, it went kaput in like literally 7 months. It was gone. And in fact, we were upside down on probably about 70% of our properties in less than a year.
Values, let's just use, the house, I'm all into this house for $130,000. It's worth $200,000 on paper.
Yeah. We're like 66% across the board, like on average, about 66% leverage point across the board when all hell broke loose. So we went upside down on most of everything.
Cash flow standpoint, cost you, it rents for $1,300 a month, and your expenses are $1,300 a month though, right? Is that kind of what you're saying?
Yeah. I mean, again, it's I think our average cash flow on like one of the single family properties we had, we might have, somewhere like the $200 a month range is what our net cash flow should have been, again, give or take. But again,
then when the market got hammered, values came down and rent
concession
came down, right?
And the concessions in Florida, everyone always preaches like rents don't go down, right? Rents, bullshit, they don't. I mean, like I witnessed it. Right. I mean, and it happened for a period of years, and it was due to, down in Southwest Florida, there was lots of open land. And so you just had spec builders building homes, beyond to where the eye could see. I mean, just nonstop rooftops coming up. This is back in the day. I know that you were in the construction side, but for folks that are listening that were in real estate back then, this is where a pre-built single family home would get flipped like 3 times before it was even like finished being built. It was absolute insanity. It happened in Las Vegas. It was happening in Florida. It's happening in Phoenix, like some of these big major markets. And what happened here is a lot of the spec builders that were building these rooftops, they started renting these homes out because they weren't selling them. And you had a lot of overbuilt apartments, and you had condo projects that went sideways. And you had a lot of apartments that were going into condo conversion that went sideways. And I mean, just you had a lot of rental inventory in the marketplace. And so it just completely
and it was
crushed.
New, right? And it's
a lot of it was new,
amenities.
And so our biggest competitor, at least in the markets where we own, were brand new single family homes that were essentially, you can get a brand new 322. You could rent it for, let's say, $1,400 a month, or you could rent my, 15-year-old home for $1,200 a month. I mean, come on, it's an easy decision to make. Yeah. And so we had somewhat of a mass exodus. I mean, we had people that weren't renewing leases, and very quickly we went from a positive cash flow, due to a higher occupancy, to losing about 18% of our occupancy very quickly, over a period of, 6-7 months. And that very quickly shot us into a negative cash flow range. And again, just the tack on all the inefficiencies with the maintenance and upkeep, it became very challenging to even find workers in that period of time. So just doing regular make readies that should take literally, on a normal make ready, take like maybe a week, to get something back online. It would take us now 3 weeks to get it back online. We just couldn't find quality help. A lot of people were just moving out of the area because there was no work for them. Yeah. So it's just like a lot of different nails that came in the coffin all at one time. We also had a lot of cross collateralized commercial debt on our single family homes. So we would buy 7, 8, 9, 10 properties, and then, with private money, and then go get a commercial loan on it, pull some money out, pay back our private lenders, and then basically have 10 loans underneath that one lump commercial loan. A lot of that commercial debt, at that point in time was coming due maybe a year or two. And so as we got closer to the term being due, we had properties that were in default. Credit was already bad, had no option of even refinancing things. I mean, it was just like this downward spiral for like a period of 2 years. There was no way to really dig out of it. All of it was upside down. We triggered a lot of defaults on the debt because of the negative equity that had basically happened due to the market. So there's just a lot of negative factors involved. And this isn't a single family thing. It's just, I think there's inefficiencies in that business. And so it's not like a single family's bad. It was just bad for the amount of energy and effort that we put into building a business to have it not actually really put money in our pocket and really be able to survive a challenging time like that. So.
So what have you done differently coming out of that whole thing?
That's a great question. So again, I look back, reflected, and back then I wasn't married, didn't have kids, and I just worked nonstop, which is fine. I had fun with it. It was a great time. Had a lot of fun, made a lot of money. However, I knew there was a more efficient way to kind of rebuild things, and I surely didn't want to do it with single family. And I was trying to be more real with myself as far as like putting stress tests on things. I came out of that basically. I mean, I was completely broke. Thank God the foreclosure system in Florida was really slow, because even my personal residence, it was in foreclosure. So I didn't get kicked out in like 6 months. I mean, I lived there for like 3 years because it was so jammed up. Right. But I was broke. My bank accounts got garnished, and I mean, it was a rough time. But I knew that there was a more efficient way to build it. And I knew that the only way to get there would be to truly put a conservative stress test, a multitude of stress tests in our business, so that, given the, situation where we run into like we lose 15% of our occupancy, God forbid a pandemic happens, right? I mean, like no one would ever think this would happen, but like, God forbid something that happens, like where is the cliff on our properties? Like how we're buying, and where's the cliff at to where, we truly can't pay our note? Like, so what's that occupancy look like? Or how about on a refinance? If we're doing a value add play, or if want to do a cash out refinance in 3 to 5 years, I can't predict what the capital market's going to look like. Neither can you. So let's take a look at where that cliff is as far as what a rate's going to look like in 3 to 5 years, right? If I'm banking my pro forma on, rates are at, 3.5% today, and they're going to be at 3.5% 3 or 5 years from now, I mean, I'm lying to myself. And so where's that cliff? And can I get comfortable with where that cliff is at? If it's at 3.75, I'm probably not comfortable. If I can make the deal still work at 5% in 3 to 5 years, I'm probably a lot more comfortable there. So just, there's no exact science to it, but just finding out where those different cliff points are, and if we're comfortable how close we're getting to them, and if we can make the deal work within that comfort zone again, which is a much more conservative comfort zone than I think what I had, prior to the recession or crash of 2008.
I love it, man. Dude, I love the fortitude, respect the hell out of you from that standpoint. So come back with a vengeance. Tell me about how you got into mobile home parks and how
Yeah.
you're now one of the biggest mobile home park operators in the country.
Yeah, it's funny. Again, real estate keeps finding me, man. I took a different route for a couple of years after the crash happened. I started a few other businesses outside of real estate, just because I was in damage control, man. Everyone, it's right. Everyone said, yeah, everyone knows the old adage of like you buy when there's blood in the street, right? But it's really hard with your blood. It's just challenging when it's your own blood out there, right? It's hard to get outside your bubble. And so I really was just in damage control, trying to keep my mind, healthy. And it was really hard to keep it healthy if I just only focused on real estate all day long. And so a couple years after, this thing kind of winded down, 2011, that fire kept burning. I wanted to get back in. And ultimately I succumbed to that fire, and I started getting back out there, just talking to everyone, not that had just made it through, but also those you had mentioned, like those that kind of made it through and then, got back up. And then those that got started like you in 2009, 2010, that were at the baseline of, after, post crash, what have you. And so I wanted to learn what that new landscape looked like, right? Lending had changed. Everything was so different in 2011 than what it was in 2007, completely different world. And during that journey, number one, I knew I wanted to be multifamily. I knew that I didn't want to work as hard to rebuild the single family portfolio. Plus it was inefficient, right? Like there was better ways to do things. Multifamily was going to be the way to get there. And during that journey, I was introduced by this guy named Randy, just by a friend of mine. Randy was a banker, happened to own some mobile home parks. I had no interest in Randy's business whatsoever, but I like meeting new people, expanding my network, and met with him for lunch. And after a 2-hour lunch, Tim, Randy piqued my interest in a million different ways about mobile home parks, enough to where I was like, you know what? I'm going to take these next like 12 months and I'm going to learn everything I can about the space. I'm going to go buy one, and I'm either going to prove or kind of disprove all these great things that Randy had to say about his small portfolio that he owned. And ultimately I did that. I bought a park in Atlanta in 2012. We still own that one today. And that worked out really well. I bought another one shortly thereafter, bought the third one, fourth one, and ultimately got to the point to where, we had kind of depleted all of our own resources a couple of years in. And that's when we actually started syndicating and building a real business out of the mobile home park space. So today we're in 13 different states, and, we're all in on mobile home parks. So love the niche. And to me, it was just it's a subsector of multifamily, right? So it's still kind of the general premise of multifamily. It's just a different type of asset.
So when you're underwriting mobile home parks, maybe you can dive into that a little bit and kind of educate us on, you got two things, right? You got the lot rent, and then you have potentially the mobile home rent if you own the mobile homes also. And the way that you purchase these things is a little bit different. You're actually buying the land with a deed.
Right.
But then there's a bill of sale for the actual vehicles that come with it, right?
Correct.
So Can you explain that process a little bit more?
Yeah, absolutely. So really the premium revenue of a mobile home investment is the lot revenue. It's to where you're basically renting the land to someone that owns the home, owns the trailer, owns the mobile home, that basically sets it on that lot and pays you monthly rent, for hopefully many years to come. That is the premium revenue. You mentioned the, owning the homes themselves. We don't consider that to be premium. It's in fact, we don't even really factor that into our underwriting. And the reason why, Tim, is, and a lot of people do, and I guess you could say there's a right and there's a wrong. Every banker I've ever talked to, every appraiser, they don't factor that income into their underwriting. However, a lot of old mom and pops still do. But anyway, the reason why we don't is that mobile homes are a depreciating asset. You cannot show me a 2010 mobile home that's going to be worth more in 5 years than what it was, today, right? It's just not going to happen. It's going to be worth less. That's it. Right. So, and then what you'll find is if you actually start underwriting that additional revenue on a mobile home. So let's say the lot rent is $300 a month. And let's say in total between the lot rent and the rental of the mobile home, they're getting $600 a month. So you got 300 and 300. If you actually do the math and it's an old mobile home, you're going to find that if you're capitalizing that actual income stream, you're way overpaying for the actual real physical value of that mobile home. And it's never going to increase. It's only going to decrease year after year. And so we always look at it this way. We look at the lot revenue, and we underwrite that based on a cap rate. And then we actually look at if there are mobile homes coming with the sale, we just put what we call as a shell value, right? Just like you would value a car, NADA value. There's many different ways to come up with a valuation, but we basically just attribute a shell value and buy them as a physical piece of property, and ultimately don't include that income stream into our underwriting. And what we have found is, again, if you run your properties tight and you don't defer maintenance and you maintain them as you should, as being a good landlord, that there really is no there really is no profits left in that additional rental income stream, especially if you have turnovers and make readies. It's non-existent. It basically is a break even at best. And
do you even own the actual trailers themselves, or
we do.
You sell or finance those to tenants?
Yeah.
Or what do you do?
Well, yeah, it's a great question. I mean, in a perfect world, we wouldn't. I mean, we own many communities where we own zero, and that's great. I mean, they are the easiest parks to manage and to run, because literally if the ACs break, the roofs leak, anything like that, they're not calling us. They're calling the HVAC guy. They're calling the plumber, what have you, the owners of that home. And they're basically, our only job is to keep the infrastructure intact, meaning the roads, the water lines, the sewer lines, which is fairly easy. If it's an area where it snows, we got to keep the snow or the roads plowed, the common areas mowed, what have you. And so very easy upkeep. And so with the mobile homes themselves, we own about 2,000 lots. About 10% of our portfolio is made up of homes that we own, not by choice. It's just whenever we buy a community, if the old owner happened to acquire some over the years, maybe they inherited them because someone passed away and their heirs didn't want it. Many different reasons how they acquire these things. We end up acquiring them as well. And so our objective is to sell them as fast as possible, basically get out from underneath the maintenance and responsibility. And so normally we'll go and we'll rehab them, we'll put money into them, and then we'll try to sell them for cash if we can. And we'll lose money on the home itself. If we got 15 into a home, we got a cash buyer come in, let's say with $7,000, and they've got a good job and they're a solid tenant, we'll lose $7,000 on that, because I know that once they own that home outright, more than likely they're staying for a long time. In fact, our average tenancy, if they own the home outright, is 12 years. So,
wow.
And so if I do a rent to own, which is another way that we'll structure it, if we can't find a cash buyer, some markets we have more challenges with cash buyers than others. We'll structure like a 10% down. We'll still put a reasonable price on the home and put a short enough term to where it's really attainable, right? Like our goal is not to make it to where they can't reach that finish line. Like I want them to reach it as fast as possible to get me out from underneath the actual maintenance and repair of that unit. And so, but I will say that even with the rent to own, someone puts 10% down. That's not a lot of skin in the game. We maybe 25% of them make it to the finish line, right? And so we still end up turning those units, maybe not as often as a rental would, but it's still there's a lot of default there.
And why not? If somebody's got good credit and somebody's really qualified to come in, they're willing to make an offer at $7,000 cash. Why not carry the other $7,000 or $8,000 as a note on the house? Because is that not enough of a commitment on their part, or you just want to incentivize them enough to jump in?
Yeah, that's actually a really good question. Yeah, I mean, it really just want to incentivize them. If someone's got, in our business, the demographic that we typically serve, if they got $7,000 or $10,000 of cash waving around, it's probably not going to be there in their hand for that long. And again, I'm not speaking derogatory by any means. It is what it is. I want to give them every opportunity and incentive to get in there now, because a cash buyer to us is like 1 in 10, right? And so like the other 9 that come through, they've got enough to do a rent to own, but they don't have enough to actually buy that thing outright cash. And so I want to make sure that we incentivize them and get them in there. So again, if they pass the background, if they look like they're going to be a solid long-term tenant for us. And again, maybe I'm leaving money I'm actually leaving money on the table. You called me out on something that I don't even know the right answer to, as far as like, why don't we just have them, why don't we carry the remainder of that over a very, just a easy to pay note. Maybe it's a 5-year term, what have you. Now they're
$100 a month for the next 5 years.
No, fair enough. I don't know the answer to that.
My wheels are turning. I was like,
no.
Right?
Yeah, I guess in my mind, the reason being is that like our, and this isn't really an argument. This I guess how I'm thinking about this. Like the lot rent in our parks, like the average lot rent across the country is about $330 a month. And it's actually about that much throughout our different communities. We've got stuff in the Northeast, Southeast, and the Midwest. So we got a bunch of different regions there. If you lost your job and things really went sideways for you, you could do just about anything to figure out how to come up with $325 or $330 a month, right? Like you could go buy a case of water from CVS and go stand in the corner and sell them for $1 a piece, and you could end up, you can make $300 a month. And so the more we tack on as far as the responsibility, the more of a chance that individual might have of actually defaulting. And so again, I'm not trying to make an excuse for me not capitalizing on that additional amount, because I think you make a very good point. But that's kind of how our mind works. And, we know that when we sell that home as well, that we just added more than likely about $35,000 to $40,000 of actual value to that park itself. And so again, leaving money on the table, but I'm willing to lose 7 to make 35 or 40 grand.
And I totally get it. I totally get why you do it that way, because the number one expense in owning any rental property is turnover. And so the more you can reduce turnover and maintain a longer tenancy, it creates a better return over time and way less headaches and easier management. And there's multiple layers of it, of why you would do it that way. So I totally get it. I was just thinking.
Yeah, there's other factors involved too, which we don't need to get into nitty gritty, but you got Dodd-Frank and the SAFE Act. So you got compliance issues as far as like truly holding notes, unless it be if it's an unsecured note, which then what's the benefit of it? If it was an unsecured note, then it wouldn't fall underneath the confines of the Dodd-Frank and SAFE Act. But if you're actually going to tie a note to the trailer, like a real note, then you would have to be, again, there's some compliance regulatory standards you have to make it through as far as being able to do that legally. But anyway, not to get into the nitty gritty here.
Why do you think like there's a moratorium like across the country on mobile home parks, right? Like there's no zoning on them or something. And why do you think that's the case? Why is that?
Yeah, I think there's two big reasons. Number one, if you've never been through a nice mobile home park and you don't own one, then you probably just have a negative stereotype of, just like the rest of the country does, that's associated with it, just that they're full of drugs, sex, crime, rock and roll, all the above. And that's just not the case. I mean, I like to say that, it's just like any apartment complex, any single family home neighborhood, like any town in the country, you got the really bad part of town, you got the middle part of town, and you got the white collar part of town. The same exists with mobile home parks, right? You got the low end ones that are on the wrong side of the tracks. You got the ones in the middle that are just good, hard workers. And then you got some actually really high end ones that are very much lifestyle communities. And so, however, we all get lumped into kind of one bucket. So I think that's one reason why it's kind of like the not in my backyard. So if you knew that if there was a piece of land next to your house where you live, and your neighbors all found out that they were planning to build a mobile home park there, even if it was a higher end park, just the word mobile home park, I guarantee there's going to be some protesters out there pushing back against that being built there. Just again, because of the negative stigma that's attached to it. Doesn't mean it's going to be a bad place. Could be actually even nicer than the subdivision you live in, right? It could be a really high end place. And so that's one of the reasons. But the other reason, which makes a lot of sense, municipalities, as far as from a tax revenue standpoint, mobile home parks take up a lot of horizontal space. Right. It's not like an apartment complex where you can fit the same number of units in probably a third of the space, right? Because you're going vertical. And so what's better from a tax standpoint, from a revenue standpoint? It's an apartment complex, right? I mean, in addition to that, whoever's going to be living from a local economic standpoint, who's going to be spending money in that local town, more than likely, you're going to have probably higher spenders that are going to be living in an apartment complex. Or if you're going to build an office building instead of a mobile home park in that same space, you're going to be attracting corporate type workers, what have you. And so it's just from a tax incentive standpoint for municipality, I could see where the argument lies to where it doesn't they'll never tell you that's the reason why.
Yeah. They can't say that.
No, they can't say that. But like, I get it. Every municipality says like, oh, we need affordable housing. We're in support of affordable housing. But from a tax revenue standpoint, there's not much benefits for them to do it, right? And so that's why it's not happening.
You got a bunch of people living on the land, but it's taxed essentially almost like raw land, right? Like the tax that the school system is bringing in is minimal. But you have a bunch of kids who are still living on the land, going to the school system, and they're losing every single year.
So you have the property tax, which are some infrastructure, so it's improved, but it's not improved such as an apartment complex. And then you got the actual personal property tax of the mobile homes themselves. And so, in some states, like we own some stuff up in New York, like some of these mobile homes are worth like 80, 90, 100 grand. I mean, they have legitimate tax bills associated with them, but still nothing to the extent of what would be there as far as tax revenue if it was a multifamily building that had 3 times the amount of units, if it was a mixed use project or any of the above, right? And so I get it. They can't say that's a reason, but like really those are the two big reasons, is the tax reason with the municipalities and then also the negative stereotype associated with mobile home parks.
Awesome, man. Well, I want to be respectful of your time. I know I told you we'd wrap up by like around 11 o'clock. So give me like, I know you're in a couple other different asset classes. Your new one is parking lots, right?
That's right.
Tell me what you're seeing in a couple of these other different asset classes and what you're really kind of focused on moving forward.
Yeah, no, that's a great question. And I'm of the mind that there's no right or wrong asset class, Tim. I mean, like you can make money a million and one different ways in real estate. You really can. Like it's not like one asset class is better than the other. Just because I had a bad run-in with single families, I know I got plenty of friends that make a killing, right, with big single family home portfolios. I just think there's an easier way. I think there's a more efficient way. And so, but I've got limited investments, as a passive partner in a lot of different asset classes. I like to focus. And so mobile home parks have been our focus. We've just recently moved over into parking lots. But as far as other investments, I've got investments in self-storage. I've got investments in multifamily, medical office space, and some retail. And so I'm well diversified, but I know I'm not a master in any of those other ones I just mentioned. And it takes a good bit of time to actually get that mastery in place. And so mobile home parks has been our space. We've started studying parking lots. About 4 years ago, I was introduced to it. About a year ago, we got hot and heavy into actually understanding the business and the niche, what have you, and just recently started diving into it and tying up assets. And so parking lots is it's like what mobile home parks and self-storage were 20 years ago as far as the fragmentation. 70% of parking lots out there, 70% of the parking lots owners out there only own two or less assets. And so very much a mom and pop industry. Wow. In addition to that, about 99% of the operators out there, there's publicly traded companies, there's national companies and regional companies, and then some local companies. But the management companies they don't own the real estate, which is crazy. So you've got all these fragmented ownership structures as far as these mom and pops, generational mom and pops that have these surface lots and parking garages, and then these national companies that are only really interested in the management of these assets. And so what it creates is an interesting vehicle for us to basically get into a attractive covered land play and actually hand off the management in a form of a lease. That's fairly typical to where we get a local or national management company to sign a 5 or 10 year lease with us with 3% increases on an annual basis. And then they basically will make the spread up and above that. And so I'll give you an example. Like we've got a small lot up in Wilmington, North Carolina in contract. We're going to be closing here in the next 30 days. We've been kicking the can because the parking business is suffering right now. It's getting its ass kicked because no one's driving their cars. But inevitably it will come back as people start opening back up and what have you. But we're buying it at $695. It had been run by a mom and pop for many years. Actually a doctor, but his son ran it. Their net NOI in 2018 was like $45,000. They used no technology, didn't accept credit cards, had no parking enforcement. It's like at a hard signalized intersection right in downtown. I mean, hot area next to all the restaurants and all that stuff. And we went to a local operator and they offered to sign a $70,000 a year lease for 10 years with 3% increases.
Net lease, triple net?
Yeah, it's a double net. So, but the taxes and insurance are so minimal because it's a surface lot. There's nothing to it. And so it's about as close as you can get to a 10 cap. It ends up being like a 9.3 cap or something like that. And we don't have to do anything. Literally, we do nothing. I mean, it's literally, they'll run it, they'll operate it, they'll put the technology in, they'll accept credit cards, they'll manage all the rule enforcement, and then they'll make the spread up and above. So,
what kind of financing is available on these things?
Yeah, that's a good question. We're not actually financing that one. We're just going to pay.
Probably just bring cash.
Yeah, that's small of a deal. I mean, really, the financing becomes available once you get into in that asset class, about $5 million and above. And it's still fairly low leverage points, probably 55 to 65 max as far as the leverage points concerned. Maybe it might even be lower than that here moving into the future as far as the volatility is concerned. But we're looking at it's more of we have a certain investor base that they've made their wealth, right? They're coupon clippers. Like they've made their wealth. They're looking to preserve it. And if we can buy these parking assets due to the fragmentation, there's lots of mom and pop assets out there that aren't being run correctly. There's still, if you see someone that's got a parking attendant sitting at it collecting cash, or you ever see those metal honor box things where you have to shove the cash into it, I can promise you that parking lot is not doing anywhere near the revenue that it actually could be doing if it was accepting credit cards and it had a professional operator in place. And so just like you find multifamily properties that are, mismanaged, we find mobile home parks, the same exist in parking lots. And that's the type of opportunity that we're looking for. And, our investors that are interested in that asset class they're looking not necessarily to hit home runs. They're okay getting, 7-8% returns, knowing that it's literally it's equivalent of like a CVS or Walgreens, right? I mean, it's a triple net lease. And it's a covered land play, typically in an area to where its current use today as a parking lot is the lowest use that it will ever be. It might be 10 years, it might be 20 years before it's got a higher and better use. but I can promise you that it will never be worth less in the location where it's at than as a surface park. You know what I mean? Like it'll never be worth less than what is a piece of land right now.
Yeah.
So like the parking lot in Wilmington, it's got 80 foot air rights to it. I mean, it's a hard signalized intersection right next to all the restaurants and all that stuff. I mean, I don't know what's going to be in the future, but it will be something probably more than a parking lot. I'm not banking on it. I'll bank on the cash flow today and then bank on the future opportunities another time.
That's a key point is you buy for cash flow. What is it worth today?
Absolutely.
And then anything else is just icing on the cake in the future. So awesome, man. Well, dude, thank you so much. Got a ton of value out of this. I always love talking with you. And yeah, man. How can people connect with you? I know Real Estate Investing for Cashflow podcast. Definitely you guys should check that out. And then, I tagged you on the social media. So make sure you guys are friended up Kevin, following him. He's puts out a lot of great content.
Yeah. So I've got, the Real Estate Investing for Cashflow podcast, which is a commercial real estate investing podcast. You can find me there. I also got a mobile home park investing podcast. And then as far as just connecting with me directly, go to my website, kevinbupp.com. You can find pretty much everything that we've got going on. And then lastly, if you have any interest in what we're doing in the parking lot space, we just wrote an ebook. It's parkinglotprofits.com. You go download a copy, what have you. But other than that, I'm pretty easy to find, man. Just like you, I'm kind of all over the place. So it's pretty easy to track me down.
Good stuff. Good stuff. Well, dude, appreciate you being here, man. Always love talking with you. And if there's anything I can do for you, man, don't hesitate to reach out.
Same, brother. It's been fun, man. Awesome. You take care, brother.
All right, Kevin. I'll see you.
All right, bye.